Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Tempus AI.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For a while now, Tempus AI has been seen as, this high potential story stock, all about oncology, data, AI, but also very expensive.
Right, a lot of promise, but maybe not the hard numbers to back it up just yet.
Exactly. But the latest Q1 2025 results, they've completely changed that narrative. This isn't just a research story anymore. It's a growth machine, and it's showing some serious operational leverage.
I agree. You just can't ignore that top-line growth. Q1 revenue?
Yeah.
What is it, $212.1 million?
That's right, $212.1 million, which is up 67.3% year over year.
And that just blew past what analysts were expecting. But the question for me is always, is this growth from one big contract, or is it the whole platform starting to scale?
It's absolutely the platform scaling, and you can see it when you break down where that revenue is coming from.
Okay.
The engine here is their clinical AI platform. That part alone grew 89% year over year to about $164 million.
89%.
Yes. So think about that. The AI-driven high-margin part of the business is now almost 78% of total revenue.
Yeah.
That is exactly what you want to see. It's a sign of critical mass, of real clinical adoption.
And when the fastest growing segment is also your most profitable, well, that's the magic formula investors look for, right? That's where you get real leverage. The margins must show that.
They do, beautifully. The gross margin took a huge leap. It went from 59% a year ago up to 68.5% now.
Wow.
That suggests they have pricing power and that their AI models are becoming more efficient as they get deployed more widely. They don't need to add a ton of new costs to serve more customers.
And that efficiency, I assume, is trickling down to the bottom line.
It's flowing right down, and this is probably the biggest surprise in the report. The operating margin improved by 1,150 basis points.
Okay, let's break that down. A basis point is 0.01%.
Right. So they basically narrowed their operating loss by 11.5 percentage points. The loss is down to just over 18%. It puts profitability on a very, very clear timeline.
And that leads to the headline number that, for me, just fundamentally changes the whole investment case here.
The balance sheet.
The balance sheet. They're sitting on $1.08 billion in cash and, critically, zero long-term debt.
That is almost unheard of in this space. It gives them so much flexibility.
But the real inflection point, the moment this company stopped being purely speculative for me, was the free cash flow number.
You're talking about the fact it turned positive.
Exactly, for the very first time. Positive $12.9 million in Q1.
We really need to pause on that because the swing is just massive.
It is. They went from negative $44.2 million in cash flow a year ago to positive $12.9 million this quarter.
A $57 million swing.
That's not a fluke. That's what happens when that exponential revenue growth and margin expansion finally hit. It means they can now fund their own growth.
Right. The risk of them needing to raise money and dilute shareholders it basically goes away.
And one data point removes a huge overhang for the stock.
It does. And you can see management's confidence in their next move. They immediately raised the full-year revenue guidance.
To what, around $850 million?
Between $850 and $875 million. The midpoint of that implies about 58% year-over-year growth. So they're telling you this momentum isn't slowing down.
A 58% growth forecast, now self-funded. That changes everything.
Yeah.
But let's shift gears from the numbers. I mean, in the AI space, a great quarter is. It's just a quarter. You need a durable moat. What makes Tempus AI defensible?
That's the billion-dollar question, isn't it? The short answer is no. A competitor can't just replicate this easily. Their moat is built on proprietary data and how sticky their platform is.
So it's not just the size of the data.
It's not just the size, it's the depth. They have over 4.2 million patient journeys. And when they say longitudinal, multimodal...
Right. What does that actually mean for someone listening?
Longitudinal means they track patients over time through diagnosis, treatment, recurrence. Incredibly valuable. And multimodal means they're layering all different kinds of data on top.
Like what?
Genomics, pathology reports, imaging scans, and this is the crucial part, the clinical notes from the electronic health record, the real-world data. Nobody else has combined all of that at this scale. It's a huge barrier to entry.
So they don't just have a pile of data. They have the story of how treatments actually performed. And that must lead directly to the stickiness you mentioned.
It does. Once a hospital or a biopharma client builds its workflow around this platform, like using their trial match tool to find patients for studies,
It becomes impossible to rip out.
the switching costs are huge. We're talking 12 to 18 months just to replace the system, retrain everyone. It creates very predictable subscription-like revenue.
And they have a regulatory head start too, right? Which is pretty rare in this field.
A big one. They have FDA breakthrough device designation for 3 of their AI tools. That speeds up the review process and gives them a level of validation that others are still chasing. Competitors tend to be more siloed.
Like just focusing on imaging AI.
Exactly. Tempus is offering the full stack solution, and that gives them a first mover advantage that's tough to beat.
And we saw proof of that approach with a huge commercial win this spring.
The integration with Epic Systems, that was a game changer.
Epic is the dominant player in electronic health records in the U.S.
It is. Over 260 major hospital systems use it. So this integration puts Tempus AI's recommendations directly into the workflow. A doctor doesn't have to open a separate program. The insight is right there in the patient's chart.
That's how you get adoption. You make the smart decision the easy decision. Okay, so fundamentals are strong. Let's pivot to the market. What are the charts telling us?
The charts are screaming institutional conviction. The stock confirmed a textbook golden cross back on January 27th.
So the short-term trend is now strongly outpacing the long-term trend.
Precisely. The 50-day moving average crossed above the 200-day. It's a powerful long-term bullish signal.
And was there a key price level that confirmed this?
Yes, it broke through critical resistance at $59.80. On the monthly chart, that confirmed a classic cup and handle pattern.
Which is a very bullish continuation pattern.
A very bullish pattern. It suggests that big money is now treating that $59.80 level as a new floor, a new base of support.
And that kind of technical breakout is usually driven by the smart money. What are we seeing from insiders, from the big funds?
The conviction is palpable, especially from the CEO, Eric Lefkofsky. He made his largest single purchase since the IPO back in March.
How much?
120,000 shares, valued at about $8.2 million. For an insider to put that much of his own capital in, outside of normal options, it sends a very strong message.
And the big institutions, the BlackRocks, the Vanguards of the world.
They are piling in. Institutional ownership surged in Q1. BlackRock, for example, boosted its stake from about 6% to almost 8% in a single quarter. It's a huge vote of confidence.
Okay, so we have strong financials, a real moat, and the charts are confirming a breakout. Let's look ahead. What are the key catalysts over the next, say, 90 days?
Well, the most immediate one is the Q2 earnings call on May 7th. The consensus is for about $240 million in revenue. After the big Q1 beat, any sign of continued acceleration will be a huge positive.
But the real strategic news is coming in June, right?
June is going to be massive for them. First, you have the ASCO annual meeting, the biggest oncology conference in the world.
And what are they presenting?
They're set to unveil their tumor evolution predictor. It's an AI model they trained on 500,000 tumor biopsies. If they can show it accurately predicts how a tumor will respond to treatment, well, that validates the entire platform.
And the second big event in June.
Their Investor Day. This is where everyone expects them to release their 2026 revenue guidance. The whisper number is $1 billion or more.
Hitting that $1 billion mark would really cement them as a leader in the space.
The dominant force, yes.
Now, beyond what's on the calendar, are there any more speculative catalysts we should be watching? Any rumors?
The big one revolves around payers. The rumor is that Tempus is in advanced talks with a major insurer, maybe someone like United Health.
To do what?
To bundle their AI tools into Medicare Advantage contracts. That would make their platform a standard, reimbursable part of care instead of a specialty item. It would be transformative for adoption.
And then there's a broader regulatory environment.
Yes, everyone's watching the FDA for an accelerated reimbursement pathway just for AI as a medical device. If that framework gets formalized, Tempus, with all its existing designations, would be first in line.
That's a lot of potential upside. But we have to be balanced here. What are the risks? What could go wrong?
Of course. There are 2 primary risks we're tracking. The first is still customer concentration. Even with all the growth, their top 5 biopharma clients still make up 41% of total revenue. Losing one of those big clients would hurt.
That's still pretty high. And the second risk?
It's the flip side of their advantage. Regulatory risk. Their whole model relies on the FDA continuing its current approach to breakthrough designations. If the regulators get more cautious or slow down the AI as software framework, it could really hinder their growth.
So they're kind of innovating faster than the regulations can keep up.
It's a delicate dance for sure.
Okay, so to bring it all home,
Mhm.
what's the one key takeaway you want our listeners to have from this?
I think the key takeaway is that the financial shift here is permanent. Tempus has proved its data moat is a high-margin monetizable asset. The move to positive free cash flow, the accelerating growth, it signals that the company is entering a new, less speculative phase.
So the market is starting to value them on execution, not just on potential.
Exactly. It's about clinical adoption, regulatory advantage, and now cash flow generation.
It's a powerful mix: data, cash flow, and some very clear catalysts on the horizon. You really need to keep track of those upcoming dates, especially what happens in June.
Absolutely. Keep those June dates circled. And remember to subscribe for continued analysis and updates on high-growth companies like this one.